Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company which is coming with an IPO today is Credo Brand Marketing. It's a company which is into multi-brand and multi-format retail under the brand name Mufti. And joining me is Mr. Kamal Khushlani, who is the managing director of the company, and Rasik, who is the CFO of the company. Company's IPO opens on December 19th, price between 266 to 280, or it's an OFS of 449.8 crores. That values the company at 2,080 crores at the upper end of the price band. Mr. Khushlani, thank you very much for joining us on NDTV Profit. To begin with, sir, you are into a retail format. You're coming with the IPO with the OFS. What is the kind of growth plans that you have, and why you don't need any growth capital?
See, we have been in this business for the last 25 years now, and we've had a profitable journey along the history of the company, and the cash that the company has been generating is enough for the growth that we have been doing always. And over and above that, there is the cash which the company has also been paying as dividends to its shareholders. So whatever we've been doing is what we intend to continue doing in the future. We've opened 31 new stores this year, and we opened the first 6 months, and we opened 52 new stores last year, and we also paid out the dividend last year. So in spite of the stores that we opened, with the way that the business has been growing profitably, we are able to generate enough cash for the growth that we intend to do going forward as well. And we have some angel investors who've been with us for more than 16, 17 years now. So it's being done to provide them an exit, and also it will help the brand in terms of providing more visibility and doing more exposure to the brand, and that will be profitable for the brand as well.
Give me a sense of the kind of growth that you've been doing. I mean, you said last year it was around 52 odd, and this year in the first 6 months you've been able to add 31 odd. What is that the run rate that you look at growing stores with?
See, unfortunately, we are not able to, we are tied down by that. We cannot be speaking too much about this. But however, like I said, in the first 6 months, we opened 31 new stores. And last year, so you can, get some kind of idea of the run rate. And last year, we opened 2 new stores, net of closures. And prior to that, also, we have been consistently doing this. And there has been a healthy rate of growth that we have seen, even across the same points of sale that we have. So both of these put together in terms of organic, which is same store growth, and inorganic, which is new expansion. Both of these, if you can calculate, is the way we intend to continue growing even going forward. We should be able to maintain the same rate of growth.
Give me a sense of the kind of performance that you have done this year. I know you can't mention numbers. The only number that I have of this financial year is of Q1, because in the RHP. And we are nearing end of Q3. How has been the performance, and can you give us an idea of a breakup of business? How is Q2 the second half of the year much bigger for you as compared to first half of the year, or which quarters are more volatile, or having more revenues going in a normal business cycle for you?
So for us, Q1 is generally muted in the revenue, and the fixed cost remains same basically. That's why the margins look a little muted in the first quarter. But they get normalized over the full year. Annually, they get normalized because the subsequent quarters revenues are higher than
so yes,
Q1.
It is a seasonal business. And in the following time, the business is more, so the revenue also is higher.
So which are the quarters where you see substantial revenue coming in? Is it in sync with the season, festive season?
Yeah, typically Q2 and Q4 are generally higher than Q1 and Q3.
Okay, and give me a sense of how you have been looking at the inventory days, because I've been seeing your inventory days have gone up to 198 days. Is that a normal phenomenon in your business that Q1 inventory days, there's a spike in inventory days in the Q1?
So Q1 is not the correct reflection of the business. Annually, the inventory days is 66 days for FY23, which is normal. Q1, because of the revenue being lower and all, it's not the correct reflection. Over the whole year, it will get normalized as last year.
So what is the normalized inventory days for you in terms of?
Around 66 days for last year should be in that region. That's normal.
And is it normal to have a very high inventory day in the first quarter?
Yes, because of the nature of business, basically. When the
See, the stores are fully stacked up. What happens is that there is a period when, of course, you stack up your stores all the time, and during that period, the revenue is lower. Hence, the inventory days at that time appear to be such, because that's the time when we have just built to the stores. It's a fresh season. The merchandise has just gone into the stores. So it appears to be that way during that time. And as Rasik said, that towards the end of the year is the right time to look at it, and that's when it gets normalized. Because when the end of season sale, after every season comes to an end, then certain goods are picked up from there and fresh merchandise is sent in. So it's a cyclical kind of business where it appears that way. So to get a better idea of the business, the annualized number is a correct number to look at. But this number could be misleading.
How do you see this segment growing, especially menswear segment, where you are there and with your private labels?
See, as per the industry report, the menswear industry is supposed to be rapidly growing. The industry is supposed to grow 2.5 times in the next 5 years, and out of that, the organized sector is supposed to grow at a higher pace. If the overall industry is supposed to grow at 21% the men's branded segment is likely to grow at almost 28.9% CAGR. And out of that, even casual wear is supposed to be growing at is expected to grow at an even larger pace than that. And it should command get a larger space of the consumer's wardrobe. So we happen to be in that spot exactly where a casual wear brand in the mid-premium to premium category catering to men. So certainly we expect to which is what we've always done. We've had a very dominant share in the market. Even today, if you see, as per the industry report, there's USPA, which has 3.81% market share. There is Levi's that has 1.72% market share, and we have a 1.28% market share as per that report. Now, in that report, however, the 3.81% and 1.72% of the USPA code reflects everything except innerwear, because the industry experts weren't able to get their revenues only for pure play men's apparel, because that's not how they disclose their figures. So it includes everything like women's wear, kids wear, footwear, or other categories that they may be into. So you can judge for yourself as to what share we've always had of the market. We've been one of the dominant players, so to say, and we shall be able to continue doing that.
Mr. Mittal, I'm looking at your advertising and sales promotion expenses. FY23 we saw a very big spike coming in advertising and sales promotion as percentage of your revenues. Is that the normalized level, or it was just one-off? And I saw the same kind of percentage, 4.3% of your revenues in Q1 as well. So, and if I compare it to FY22, it was 0.65. So I'm just trying to figure out, is 3 to 4% the normalized level of advertising and promotion expenses for you?
Absolutely. 3.5 to 5% is normal. See, in FY21 and 22, those being COVID years, making advertising spends and all was not making sense because of the restrictions that the government had imposed, basically. So that time was a difficult period, and there was there was no benefit of doing the marketing. So FY23 spends are normal. That can be seen in Q1 of the current year also. Normal means around 3.5 to 5% is normal.
That's the range in which we've been spending and will continue to do.
Your touch points are are roughly over 1,800 touch points you have, and with EBOs of 404, which accounts for 61% of your revenues. Is that the strategy to go more, come out with more EBOs?
So, the sales reflected, the EBO sales are 57 odd percent and not 61.
So if you see, it would be if we see FY23, that is a normal this year. FY23 EBO sales were 57%. Q1 again it depends on how the billing happens to which channel. So annualized numbers are a better reflection of the business.
So even if 57%, is that the way you plan to expand your store coverages?
Yes. See, India is showing enough of an appetite across for growth across all types of cities, whether it's metro, the tier 1, tier 2, tier 3 towns. All kinds of towns are showing an opportunity for growth and an opportunity to do all its channels, including there are new department stores coming up, there are new large format stores coming up, there are new MBOs opening up, there are new EBOs opening up across all kinds of cities, whether it's metro, tier 1, tier 2, tier 3. And we see both opportunities of horizontal as well as vertical growth as we have been witnessing in the past, even coming in the future.
So EBO revenues will continue to be higher than other channels.
Okay. My other question was with respect to your supplies. The manufacturing which is done through your partners, are there long-term partnerships which you have with them, long-term supply agreements which you have with them?
So, see, I'm first generation entrepreneur, and this business has been built, on relationships. And of course, even with our, and the relationships have been built across both front end and back end. Whether it is our, franchisees, more than half of them are more than 5 years old. Some of them go back to inception and continue to expand their stores with us even today. Even at the back end, similarly, we maintain relations. We work with all top suppliers in the country, and the top suppliers who work with us have been working with us for more than 8 to 10 years at an average. And that's because the way we deal with them, I'm not just talking about ethical dealings, where we ensure that we pay them within 7 odd days of them supplying the goods to us, etc. But the way we work with them scientifically to ensure that whatever lines they commit to us, we ensure that they have all raw materials ready in time to be able to get an optimum output from the machines that they have committed to us, so that there is an efficient, production output that they get, whatever they desire, be able to economize their costs. So we work very, very closely with our partners, and we have IT-enabled systems that give us an entire view of the life cycle journey of the product, starting from ordering the fabrics, buttons, labels, when they're going to reach the factory, and once they reach, what is the date they're supposed to be cut, and once they're cut, when they're loaded on the machine, what is the actual output from the machine versus the expected output, and how do we get to the optimum level, and once they're out and they're checked, to ensure that there is a quality production produced out of that. We have 2 strong teams also that monitor this. One is the production team that ensures that the input is done properly, and there is a quality assurance team that ensures that the desired output in terms of quality is also achieved in the production that we do with these factories. So we work very, very closely with our vendors and have a very good relationship with them. Even through COVID, we were one of the partners who, thanks to being cash rich, we helped our vendor partners in every way that we could, to ensure that we kept on making payments to them on time to time and kept on picking up the goods as and when we could. So yes, they also supported us, and we've been supporting them consistently over these years, and that's how we work together.
Give me a sense of your online strategy. I saw, on the full year basis, your total online sales or through distribution, online distribution was 5% in FY23, but in Q1 it rose to close to 14%. Is that a one-off thing, or is there a conscious effort to go online with your products?
See, it's a good question you ask. Typically in our industry, the most important thing is be able to liquidate whatever you have produced profitably. So as a company, That's something that we've learned to do over the last 25 years of existence, and we have a playbook which we follow, and that is something that we have been doing consistently. So if whatever we have produced, as long as, like I said, we can liquidate everything profitably, this is a good business to be in. So whatever we produce and whatever is sold by end of season sale is sold at the EBOs, then there's a certain percentage of goods that we receive back after end of season sale that we call old season merchandise. Typically, we use the e-commerce channel, the online channel, to liquidate old season merchandise because as on date, the consumer in India is lured there by discounts, and that is a channel which we use to liquidate that merchandise. And we do not make special merchandise which is cheaper in quality, etc. to try and lure customers over there. And since we to maintain a balance of our products as to whatever we sell on whichever channel is of the same quality and is available at the same price to our customer, whether he touches us at online or my EBOs or the laundromat stores or our MBOs, he should get the same product at the same price at the same time. So keeping that in mind, the way we have grown our business, always calibrating it through the profitability lens, we use this channel as a channel to liquidate old season merchandise. And as the consumer in India, just like some Western markets, the consumer has evolved, where he's evolved being ready for full price purchases. Whenever he's not been ready for full price purchases, yeah, and the consumer acquisition cost at that time would get neutralized a bit. We are readying ourselves for that. Whenever that happens, we would be there and increase our revenue on that channel.
Mr. Mittal, final question to you. How has the price point been moving in terms of realization for you per unit cost? Have you been able to push up the price points every year? If you can give us an idea on that.
So during COVID, due to the inflation, we've been able to pass on the inflation to the consumers, and the realization for us has been normal.
Yeah, please go on.
So it's been normal for us basically. So whatever, sorry, you wanted to
see what happens is that whenever there's a rise in raw material prices, there's a certain cascading cost it has in terms of leading to the cost that the consumer bears. Within that, we have, from the relationships that we have with our vendor partners, we're one of the people who are able to derive all the best prices out of our vendors, as well as our manufacturing partners and our fabric suppliers. As I said, we work with them in a partnership. Having done that, with whatever the company can absorbs, the rest gets passed on and naturally gets added into the MRPs. But due to the high inflation during COVID, is what Rasik meant, that during that time, people had no option but to pass on these costs and had to increase MRPs, which is what every brand in the country had to do and all over the world had to do, which is what we have done. And yes, our brand is much loved by some of our consumers who keep coming back to us every time. And the consumers, yes, they buy our products even today at the MRPs that are much higher than what they were pre-COVID. And it's the same for most brands, yes.
Gentlemen, it was a pleasure talking to you today. Your IPO, Credo Brand Marketing IPO, is opening on December 19, price between 266 to 280. There's an office of 49.8 crores that values the company at a little over 2,080 crores at the upper end of the price band. Thank you for joining us on NDTV Profit.
Thank you.
Thank you so much. Thank you.